When most people hear the word trading, their mind immediately jumps to fast charts, flashing prices, and people trying to predict the next big move. But before any of that complexity comes into play, there's something much simpler and much more important to understand. That foundation is spot trading. Spot trading is the act of buying and selling the actual cryptocurrency itself, not a contract tied to the price and not a leveraged position. It's not even a derivative. So when you buy on the spot market, you own the asset. It sits in your wallet. You can hold it, transfer it, or even use it. That simplicity is exactly why spot trading is where every beginner should start. On Binance, spot trading works through what is called an order book, but it helps to picture it in everyday terms. Imagine a marketplace where buyers and sellers are constantly negotiating. On one side, buyers are saying, I'm willing to pay this price. On the other side, sellers are saying, I'm also willing to sell at this price. When a buyer and a seller agrees on a number, the trade happens. Now, that is the core mechanism behind every spot transaction. What you're really doing is exchanging one asset for another. You're offering USDT in exchange for Bitcoin, and somewhere on the other side of the system is someone willing to do the opposite. The simplest way to participate in this process is through a market order. A market order tells the system that you want to buy or sell immediately at the best available price. You're mostly prioritizing speed over precision. And this can be useful in fast-moving markets where hesitation might mean missing an opportunity. However, speed comes with its trade-offs. Because you are accepting the current available price, your final execution price may not be exactly what you expected if the market is moving quickly. The difference between the price you expect and the price you receive is known as slippage. For beginners, market orders feel comfortable because they are straightforward. But it is important to understand that simplicity does not always mean optimal pricing. If you want more control, you use a limit order. A limit order allows you to define the exact price at which you are willing to buy or sell. So instead of chasing the current price, you set your terms and watch it. If the market reaches your specified price, the trade executes. If it does not, your order remains open. This introduces patience into the process. For example, if Bitcoin is trading at 40,000 and you believe it offers better value at 38,500, you can place a limit order at that level and allow the markets to come to you. Sometimes it will reach your price and sometimes it will not. But the key difference is that you are no longer reacting to the market, you're planning your interaction with it. This distinction between markets and limit orders also determines whether you are classified as a maker or a taker. And when you place a limit order that waits on the order book, you are basically adding liquidity to the market. You're effectively making it easier for someone else to trade. When you place a market order that executes immediately, you're taking liquidity from the existing orders. And on Binance, this difference affects the fees. By default, trading fees are around 0.1%, but makers often pay slightly lower fees than takers. And using BNB to pay fees can provide additional discounts. These percentages may appear small, but over time, they compound, especially for active traders. Cost awareness is part of responsible participation. Beyond basic buying and selling, there are other types designed to manage risk. A stop limit order introduces a trigger price. And once the market reaches that trigger, a limit order is automatically placed. This actually allows you to define boundaries in advance, rather than making emotional decisions in the moment. For example, if you purchase an asset and decide that you're only comfortable with a certain level of downside, you can set that protection in advance. A trailing stop takes this idea further by adjusting dynamically as the market moves in your favor. If the price rises, your protective level rises with it, preserving gains if the market reverses sharply. These tools are not about complexity, they are about discipline. They reduce the need for reactive decision making. To understand how prices are determined at any given moment, you need to look at the order book itself. On the trading interface, you see bids displayed in green and asks displayed in red. The bids represent buyers who are willing to pay certain prices. And the asks, they represent sellers who are offering their assets at specific prices. The highest bid and the lowest ask are typically very close to each other. And the difference between them is known as the spread. A small spread generally indicates a liquid market with very strong participation, whilst a wider spread can signal lower liquidity and potentially more dramatic price swings when large orders enter the market. The depth chart provides a visual representation of this information. Instead of numbers alone, you tend to see shapes that illustrate the cumulative buy and sell interest at different price levels. Large clusters of buy orders are sometimes referred to as buy walls, while large clusters of sell orders are known as sell walls. These can suggest areas where the price might encounter resistance or support. However, it is important not to overinterpret them because orders can be added and removed quickly. And sometimes large walls create the illusion of demand or supply. That disappears just as fast. The order book is a useful tool, but it should be seen as context rather than certainty. Slippage becomes especially important when trading larger amounts or during periods of high volatility. Imagine placing a large market order expecting to buy at a certain price. If there are not enough sellers at that exact level to fill your entire order, the system will continue filling your order at the next available price. This can result in paying more than anticipated, and one way to reduce slippage is to break larger trades into smaller segments, and another is to rely more on limit orders so that you can control the maximum price you're willing to accept. Being aware of slippage transforms it from a surprise into a manageable factor. After trades are executed, your responsibility does not end. You should regularly review your open orders and see what is still pending. And check your trade history to understand how your decisions actually played out. Awareness of your activity builds experience. And Binance also provides additional features beyond spot trading, including earning options, educational resources, and payment tools. However, these are extensions. The core participation basically begins with understanding how spot transactions function at a mechanical level. When you combine all these elements together, spot trading becomes far less intimidating. It is not about predicting the future with certainty. It's more about understanding how orders interact, how prices are formed, and how fees accumulate. Also, having discipline actually protects you from emotional mistakes. The difference between someone who clicks buy impulsively and someone who really understands the structure of their trade is not intelligence, it's awareness. And spot trading is the foundation of that awareness. Once you grasp the mechanics, every decision you make becomes more intentional. And that intention is what ultimately separates the guessing from participating with clarity.